Japan is the most heavily indebted country in the world, but it looks like it may be finally growing again after 30 years. In the 1980s, Japan was booming. Japanese companies like Sony, Toshiba, and Panasonic dominated the international markets. Real estate was also at an all-time high, and the 3.4 square kilometers occupied by Tokyo's Imperial Palace was worth more than the entire real estate value of California. It was expected to be only a matter of time before it became the biggest economy in the world and eclipsed the United States. But in the 1990s, Japan's economic bubble burst, causing 30 years of economic stagnation. As other countries have continued to grow, Japan has remained still. But in September 2023, something strange happened. The Tokyo Stock Price Index, an indirect measure of Japanese business growth, reached its highest level ever, crushing the previous record set 34 years ago in 1990, a time when the internet had only just been created. This matches another trend in the Japanese economy: rising levels of foreign investment. In the last 15 years, Japan has gone from having money consistently flowing out of the country to seeing $67 billion enter the economy in 2022. A rising stock market and more investment has made people confident about Japan for the first time in many years, all because of something a little unusual. You see, Japan is actually benefiting from the same things which have been crippling European economies: labor shortages and inflation. While these may sound like bad things, they're actually really good for Japan. Job shortages mean that businesses are growing, and they also mean that workers will be paid more, something which is desperately needed, as even after accounting for inflation, Japanese wages are barely more than they were in 1990. More confidence and higher wages means inflation is hitting levels not seen since the 1980s. This is welcome news for an economy which has had decades of deflationary spirals. These are changes which have been long overdue. Whilst life in Japan is still of a higher quality than most nations in the world, its future outlook is perhaps the best it's been in the last 30 years. So let's find out if Japan can really capitalize on this trend, or whether it will just stay the same. What's interesting about Japan is that its sudden rise to a leading global economy and then subsequent decline was all done without a vast wealth of natural resources. Whilst many of the current largest economies have their beginnings and current day positions rooted in commodities like oil, Japan grew in another way, largely independent of other countries and resources. After years of relative isolation, in the mid-1800s, Japan started to trade with the United States and European countries, rapidly adopting Western technologies, institutions, and modes of industrialization. Japan continued to modernize quickly, and by the early 20th century it was a formidable force, engaging in regional conflicts and expanding its empire. This period of aggressive expansion and militarization culminated in World War II. Japan's role in the war and its aftermath would forever change its place in the world. The war set the stage for Japan's post-war recovery and eventually led to it becoming the economic powerhouse it is today. Having been devastated by 2 atomic bombs, the country was essentially starting back from square one again. Japan had lost 93% of its steel, 80% of its ships, and over a quarter of its buildings. The economist Milton Friedman once said that the best way to grow rapidly is to have the country bombarded. Though it's hard to imagine a country prospering after losing everything, the Japanese post-war economy did just that. With similar motives to the Marshall Plan in Europe, the American Truman administration decided that a stronger, freer, and more liberal Japan would help stave off communist advances in Asia and the Pacific. Wanting to establish a strong middle class and free market thinking, they gave Japan around $2 billion in aid to redevelop, a sum which is roughly equal to $20 billion in today's terms. This aid coincided with a procurement boom from the Korean War, which started to sow the seeds of Japanese manufacturing, as they supplied American troops with weapons and other forms of machinery. And over the next 20 years, Japanese companies continued to import technologies from abroad and make improvements on them. This formed the basis of their economic miracle period of export-led growth, which, along with some business-friendly policies like low interest rates and tax rates, encouraged businesses to thrive. With better technologies and access to large amounts of money, Japan was closing in on other Western economies, and Japanese businesses started putting out some of the most innovative products the world had ever seen. Things like the Walkman, the CD player, and even the bullet train. By the 1980s, Japan accounted for around 10% of exports globally. These advancements also extended into their manufacturing process, which gave Japan a competitive edge, meaning their products were both affordable and usually better quality than ones from other countries. Productivity was booming, and Japan quickly became one of the largest economies in the world. So giddy was the hype around the Asian economy that many economists predicted that it would only be a matter of time before it became the leading global economic superpower. This of course didn't happen, but by the 1980s, Japan was skyrocketing. Tokyo was emerging as a new global financial hub, being a brief world leader in terms of market cap in 1990. However, Japan was unknowingly at its peak. Its GDP was around $4 trillion, a figure which is roughly the same as what it is today. So why am I telling you all this? Because it shows the heights from which the Japanese economy has fallen. From having the world's largest companies in 1990, now the top 3 largest American companies have a market cap larger than the entire Japanese stock index. From being moments away from the world's biggest economy, Japan fell into a period of decline, meaning economically it's in roughly the same position it was 30 years ago. Japanese interest rate rises at the end of the 1980s finally popped the bubble, bringing the demise of the housing market, financial market, and economy in general. Over the next 3 decades, Japan suffered from 3 large economic problems: debt, deflation, and an aging population. Firstly, deflation. Picture you are a Japanese citizen at the beginning of the 1990s. The Japanese housing bubble has just popped, and you are now left with a massive mortgage for a house which has been massively devalued. The house could no longer be sold to repay the mortgage, and to make the payments, you would have to cut down on lots of expenses to scrape by. This situation was multiplied millions of times across the economy, causing a complete loss of confidence in the country. Demand for goods and services rapidly declined. With the amount of things being produced, the supply in the economy stayed the same. After all, factories were still producing the same amount, and there were still people looking for jobs. And when the supply of something is greater than the demand, the price will inevitably drop to reflect this. This is a textbook cause of deflation, and is exactly what happened in Japan, with some pretty bad consequences. This is where the role of debt really starts to make matters worse. In its bubble period, not just individuals, but the whole nation in general had become heavily indebted. And the price of the debt that they now needed to repay remained the same inflated figure from before. But prices, which also determined wages, were falling, making it harder and harder to pay off the debt. This created a spiral, as borrowers spent even less and prices continued to drop even more, making the situation worse. The Japanese central bank, seeing this, did cut interest rates to help ease the measure, but not by enough. In hindsight, they did not realize how big the bubble had really been, so smaller cuts didn't really do much to dampen the deflationary spiral. Over the course of the next decade, monetary policy adjustments were cautiously implemented, predominantly through minor reductions in the interest rates in an effort to stimulate economic activity. But despite this, deflation was persistent, and the effects of this were dire. Consumers, anticipating lower prices, delayed purchases, which in turn dampened economic activity. Because of this, banks, wary of the unstable market, reduced lending to businesses, also bringing down investment and innovation. This economic stagnation culminated in the 1998 financial crash, forcing the Japanese central bank to undertake a massive bailout of its banking sector to prevent a complete financial collapse and stabilize the economy. Despite the bailout, deflationary cycles continued well into the 2000s, and the debt which was present from it was still there. It had just been transferred from the private sector to the government. This Japanese government debt continued to rise, from 113% in 1997 to around 263% of GDP today, which has consistently been the highest figure in the world for many years. Japan has been largely able to get away with it, as much of its debt is owned by Japan's own central bank and own population compared to other nations. This unique position of internal debt ownership gave it room to experiment, in particular under the leadership of Shinzo Abe from 2012. His tenure was marked by the introduction of Abenomics, a series of reforms designed to revitalize Japan's stagnant economy. At the heart of Abenomics were three arrows: aggressive government spending to stimulate demand, negative interest rates to encourage borrowing, and quantitative easing, essentially increasing the money supply on an unprecedented scale to inject liquidity into the economy. These measures, radical in nature, were based on a theory that a substantial government intervention could jolt the economy out of deflation and are on a path to sustained growth. And all of these reforms mean that Japan's economy should in theory be doing quite well, but all the progress made to break out the cycle of deflation has been offset by perhaps the biggest factor in Japan's demise: their rapidly aging population. It was around this time in 2012 when Abenomics kicked in that Japan reached its peak population, a figure which has been falling ever since. In this period, Japanese productivity, a key source of economic growth, had been keeping in line with other nations. This was all being outstripped by its rapidly shrinking population. After all, a smaller workforce means smaller wage income and less money being spent in the economy, which is no wonder why deflation has been so difficult to get rid of. In fact, when we control for a factor like aging population, Japan's GDP per capita of working age people has been growing roughly at the same rate as other developing nations. But Japan's rapid urbanization since the 20th century, characterized by increased apartment living and a work-centric lifestyle, has contributed to declining birth rates since the 1990s. This demographic shift presents a significant challenge. A dwindling workforce is tasked with supporting a growing elderly population. What makes this worse is that Japan faces unique hurdles in addressing its demographic decline. The country's language barrier, stringent work culture, and cautious stance on immigration limit its ability to attract and integrate foreign talent. Consequently, Japan reports lower participation rates amongst women and migrants compared to other developed nations. And despite some recent labour reforms, significant changes in the workforce participation and demographic trends are inherently slow. All of this suggests that Japan may grapple with labour shortages for many years to come. So given a generally poor state of affairs over the last 3 decades, why are people suddenly optimistic about Japan again? Japan's demographic challenges often dominate discussions about its future, but it does have reason to be optimistic about another part of its economy that has been consistently performing. By looking at this graph showing Japan's potential growth in the last 30 years, we can see that productivity has always been a major factor driving the nation, even when in more recent years, labour and capital underinvestment have started to detract from growth. Productivity, as we've mentioned before, is essentially the efficiency with which goods and services can be produced. And the Japanese work culture, while frequently criticised for its intensity, has historically been a bedrock of productivity. This, combined with significant technological advancements, were the direct causes of Japan's economic growth in the post-war period. Despite a deceleration in innovation and technological change, productivity has more or less stayed the same, underpinned by a strong work ethic and a highly educated workforce. Essentially, what all of this suggests is that if Japan can further increase its investment and leverage technology in its production methods, then combined with its solid productivity, it has the potential to experience some real levels of growth. People are also optimistic given Japan's role and proximity to Asia. As the Asian subcontinent emerges as the fastest growing economic region globally, Japan's strategic position within Asia and its long-standing connections across the continent are set to yield significant benefits. About 50% of Japan's exports go to Asia, and businesses are well placed to meet the needs of a growing middle class in the region for the future. The surrounding optimism about Japan's potential for future growth is of course causing some growing concerns and general speculation about how Japan is going to deal with its declining population. This is mainly because Japan is the first major economy to see population decline of this scale, and so the effects of it are relatively unprecedented. Economists and scientists trying to model and predict the outcome of Japan's decline will have a new mathematical and scientific challenge on their hands, which is where the sponsor of today's video, Brilliant.org, may help. Brilliant offers a unique approach to learning that helps you learn by doing, giving visual, interactive, and hands-on approach to learning that's not only effective, but also really fun, meaning you can master concepts in as little as 15 minutes per day. It's not just for super tough concepts either, and offers education no matter your starting level. Each lesson is filled with hands-on problem solving that lets you play with concepts, a method which has proven to be 6 times more effective than watching lecture videos and helps develop critical thinking skills. Brilliant has recently launched a ton of new content in data, all of which uses real-world data to train you to see trends and make better informed decisions, and they cover many more topics from AI to engineering. To try everything Brilliant has to offer for free for a full 30 days, visit brilliant.org/theinvisibleHand/ or click the link in the description. You'll also get 20% off an annual premium subscription. Thanks again. The country experienced a relatively brief post-war baby boom, and combined with the world's highest life expectancy at 83 years, Japan presents a unique demographic landscape. This has given rise to the concept of shrinkonomics, a term that encapsulates Japan's innovative economic adaptations to a shrinking population. The crossover of their demographic demise and the rise of technology also gives potential to new, innovative solutions to maintain growth, which could be adopted across the Western world in the next few decades. As Japan navigates its demographic challenges, it's turning to robotics and AI to bolster its aging workforce. The evolution of technology, while often feared for its potential to displace jobs, has historically led to the creation of new employment opportunities by reallocating human resources to areas where they are most needed. For example, the introduction of ATMs transformed the banking sector, not by eliminating jobs, but by shifting the focus to loan operations and personal computer services, areas where human skills are irreplaceable. This highlights an important economic idea. Creating value isn't just about machines. It's really about how people can adapt and innovate. As Japan brings in new technologies, it's preparing itself to smartly handle the issues to come with having fewer births and more elderly people. The challenges of a declining birth rate, aging population, and depopulation are significant, but they are not insurmountable. By embracing and integrating new technologies, Japan can mitigate the impacts of its demographic trends. While Japan may still continue experiencing economic growth, the real question is how much this matters to its citizens, especially when compared to their quality of life and cultural heritage. In Japan, while the economy may not grow as fast as before, people deeply value their way of life, community, and traditions. These elements bring happiness and fulfillment that can't be measured just in dollars and cents. Japan's excellent public services, healthcare, and education ensure a high standard of living, softening any economic slowdown. For instance, Japan's initiatives in sustainable living and environmental conservation are not just about being eco-friendly, they're about creating a society that's resilient and forward-thinking. By focusing on innovation in these areas, Japan is redefining what success looks like, showing that a rich cultural life and societal well-being are as important as economic indicators. As the first major economy to face such demographic shifts without relying solely on growth, Japan is pioneering solutions that many other countries will need to consider. This shift towards valuing quality of life over endless economic expansion offers a glimpse into a future where the world's advanced economies might thrive by focusing on sustainability, innovation, and the happiness of their citizens, not just their economic output.